That this webinar is for illustrative and educational purposes only. Alright, so with that being said, we're going to go back up to our Market Analysis and Education tab. Hit the workstation button here on the forex-trading-unlock.com website. Alright, and we're going to go down past the numbers and skip past that. There's a lot of stuff going on in the news, and I'm sure that a lot of you, depending on which currency cross that you happen to trade, are going to have all kinds of questions that you happen to trade going on in the marketplace right now. For sure, we have a lot of very interesting things. The UK especially has a lot going on with, as far as a week and a half ago, talking about all kinds of tax cuts, and now they're overturning them, and the whole question is, what are they or are they not going to do? It's a complete teeter-totter, tug-of-war thing going on, and it's very political. You got to remember, they have Brexit, they got rid of Boris Johnson, and in that switch, they basically just put one of their own in place in the interim, and the question is how much power do they have? What's the vote going to go like? And we'll see how that all pans out. So definitely for sure today, the dollar was taking a little bit of a profit-taking move against it, and it's all pretty much kind of understanding, considering how strong the dollar was last week. And the euro was one of the currencies that moved the most against the dollar. Now, I would be very leery about what the fact of whether or not this move is very sustainable. One of the main reasons being is the fact that the yield curve is definitely not showing us any reason to believe that this move is sustainable. Right now, the way we're looking at it with the yield curve is that we have a Fed meeting coming up, and that Fed meeting is going to yield exactly what everybody's expectations is, and that is an interest rate hike, to say the very least. The question is, will it be the 3/4 basis point that everyone's expecting? Most likely, considering that there's still one more move. I think before they lay off the gas, they're going to probably make sure that they solidify one more big move in November. See how that does or does not excuse me, shake up the marketplace. I don't think necessarily that it's going to be such a big move when it does happen, just because of the fact that there's a lot of built-in expectations. So, but the euro for sure, as you can see, is winding its coil. So the market has been trending lower, making lower move lows, lower move highs. Up until recently last week, it made a higher move low. But that doesn't mean necessarily that the trend is changing. That just means that in relationship to this major swing high, or lower swing high here, we're making a higher move low from this last major swing low. Doesn't mean that this is not a pause for the cause before it falls apart, just like when it did over here, or over here. So it's very likely that the trend is your friend here. You got to remember that the excuse me, the European economy is collapsing right now. The UK obviously is in a tug of war. This does not bode well for strength for those currencies versus the dollar. I think that what you're noticing over the past few days, for the most part, is a profit-taking rally in the currencies against the dollar, meaning that the dollar has been pressing the trend so much that right now it's time for a little bit of a pullback. And as we get through some of the other currencies, you realize that even though the euro did not make a lower move low in the overall trend, other markets are making lower move lows or higher move highs, dollar versus that currency pair, depending on which one we're talking about. So for any of you that are involved in any of these currency pairs that we're talking about, and if you have any questions, make sure to put something out in the chat, and we'll try and get to it as we get through these currencies. So real quick, we'll look at the Dixie for overall direction here. We can see that today, obviously, the dollar took a little bit of a hit. Now, ironically, yields definitely are not really reversing course right now by any means. And if you look at it, it doesn't mean anything more than a consolidation. After all, overall, this market is in a bull trend. This is like an inverse picture of what we just looked at with the euro. And overall, it is still maintaining the channel. The question is when do we start to no longer, at least not get bearish, but at least neutral for the US dollar. 1 ton, basically 110.01, basically 110 even. This is your threshold. If we fall through here and that break starts to really build, I believe that you'll start to see a lot of selling pressure in other against the dollar versus other currencies if the dollar index falls below here. Is it ready to do so? I don't know. There is a possibility for it. We do have a potential head and shoulders forming. So why do we bring this up? Well, because it's very important. It's a very fundamental pattern that happens all the time, and not that it is going to happen, but it could. So here's here's the potential head, and then here is a potential shoulder. And if the market is turning, this trend line here is our neckline. So this is the first line holding up this head and shoulders pattern, and then we'll even go down to here, and we have another right here. So we have more of a channel holding up the trend as it is right here, but that's not the most critical one. So we're going to change the color on this and make that more of a red. If it falls below there, we've already taken out the neckline. Odds are we're going to target this area here, and any failure from there definitely is a sell signal. Okay, so right now we have a potential head and shoulders formation forming. Interestingly enough, as we're speaking, the Euro US dollar is actually making some nice new move lows on the intraday. It still has a ways to go. We'll see how that pans out over the course of this evening's session. And also we have the British pound that is toddling around as well. We'll see how that starts to shake up in the course of this webinar. All right, so we have one more thing to highlight. Our potential shoulder here. Oops. All right, for those of you that are not familiar with classical bar charting patterns, head and shoulders, this is where we have this high becomes a shoulder, we have a retracement, we rally up past the shoulder here, creating the head, which is this area up here. We pull back here, which is now how we just developed the neckline, okay, this rising little support line here. And this lower swing high becomes the shoulder. The fact that it's a lower swing high is how we know that we definitely have a shoulder formation forming. Does it mean that this is a head and shoulders? Absolutely not. So if we get a rally above the shoulder here at 113.92 in the dollar index, all bets are off. We're getting very bullish. The trend is most likely going to remain intact, and we'll make higher move highs most likely. Once again, this neckline is our first line of defense. If we fail through here and then fail through this support line here, odds are we are going to take a run at this 110 even basically, and anything below here becomes very bearish. All right, so now let's go to the Euro US dollar. In this instance, we have pretty much the opposite forming. And interestingly enough, in front of that, we have something much different. So, oops. We'll put this one up here. And now let's highlight. What happens if this here is a head? And this here is a shoulder. Now the dollar index is composed of all the major currency pairs, and interestingly enough, the euro is one of the most significant ones of all of them. So for those of you that aren't aware of that, that is something you need to pay attention to. Where the euro goes, typically the dollar index goes as well. Not necessarily completely in tandem, but it does trend very, very similar. So that's something you need to pay attention to and definitely watch out for. All right, so if you have any questions about that, now as you can see, it just says we had the head and shoulders in the dollar index. Now we have a head and shoulders here forming in the euro. So we have the recent major swing low here. That's our head. We have the recent higher swing low from last week. This is our second shoulder. And now we are going to draw our neckline, which goes from this point down to here. Now see how this one's red? Well, we're going to go back to gray on this one. Oops. Let's get it into, there we go. And then the other one, we're going to turn that one to red because this is a reverse head and shoulders. It's just an upside down version of what we saw forming in the dollar index. So now our neckline is here, and then our longer term support, our resistance line is this red line, trend line here. And if we cross those, odds are we're going to test this one basically parity for the euro US dollar, which if it does get above there, that is bullish. That confirms the head and shoulder, and then you would expect a challenge of at least the 102 even area. So you're looking at a good two-handle move above this breakout line for sure with this head and shoulders. And because that comes on another key pivot area of this last swing high, I think you could probably get a move above 102 even. Is that going to happen right away? Most likely not. There's a lot of fundamentals that have to come into place to make this happen. Now it could. It's very likely that if, especially since we have the Fed meeting coming up, that over the next week or so we're going to have a rally that's going to run up and challenge this area here. For the main reason is this is a profit-taking move that could get a little exaggerated. You know that once we get into this area here with the Fed meeting lurking ahead with only the beginning of November, we're only a few weeks away. That meeting followed by another one with another hike coming, we should most likely come back and test these lows. How far are we going to get to? Well, I had 95 as a target by the end of October into November. We came very close to it already a few weeks ago, a little ahead of schedule. That was when I thought we would be down in that area. Is when I thought we'd be down in that area, not back then. So we've had a nice bounce. So the question is this head and shoulders formation going to be real or is it not? Now here's the key thing that you got to pay attention to. The pattern hasn't been confirmed, and the good thing is since we know that it's shaping up, this shoulder here, just like it's upside down from the dollar index, if we fall below 96.36, all bets are off on the head and shoulder. Head and shoulders pattern. Odds are we're going to make a low for this a run for the low that we had set here back on September the 28th. If we get below there, I would think that, I said I had a target of 95 even by the end of October, sometime in November. And 95.40 was the low. We only got a few more pips to go to take out that low and hit my target number. 95 cents, I think, is the very least minimal extended target you can expect to see if we take out those lower support levels. I think momentum is most likely going to build. Now, I don't think we're going to slam it down into the 80 handles right away, but I do think that we could go below 95. It's going to probably be a little bit of a grind, but I do believe that we can get down to good 94, even to 93.5 before we start to see a consolidation. And then we'll see something like maybe where we round out a bottom like this, bounce a couple handles, and then start to consolidate for a couple weeks. I would expect that to happen because that would put us into the holiday trade. Perfect scenario would be that we get this little rally over the next couple of sessions, then all of a sudden it falls apart, or even falls apart over the next couple of days, then trades lower into the Fed meeting. We make new lows. We take out those lows. Then we get a nice little bounce for a week or so because we know we have one more Fed meeting to end the year out in December. Get a little consolidation like this, and then kind of like a little up-tip spike, and then bam, slam down, or even get a slam like this that we had in September to end the year in December. So that would put us down into the lower 90 handles, even down towards 88 even. These are longer term targets. As long as the economics of scale continue to be the way they are, there is absolutely no reason to believe that this will not continue, this trend. Not that we're not going to see a big correction against the dollar. I definitely think you're going to see a big correction in the dollar, but And it is brewing, but right now the fundamentals and the technicals all are lined up with a dollar bull. All slides against the dollar are viewed right now as breaks to buy, rallies to sell in the other currencies versus pairs versus the dollar. All right, so slightly lower on the day. We have these formations forming up. Let's see, do we have any questions? We have no questions. Let's see, on Twitch or on anywhere else. That's all right. We got some nice likes, though. Thank you very much on YouTube. And also, if you got any comments, please, we really appreciate for the algorithms that you put a comment on the chat, and also please on the comment section, especially on YouTube and also on Twitch. If you put leave comments for us, that's huge for the algos. We appreciate it very, very much. All right, so with that being said, we have no questions going on there. There is nothing wrong with that whatsoever. All right. So now we are going to carry on to the British pound, U.S. dollar. Now, the British pound is coming to the news a lot lately, mostly because you have, in the wake of Brexit and Boris Johnson being removed, you have the current leadership that will eventually most likely be voted out and turned over, or maybe not. Maybe just change with someone of the within their party. There's a lot going on in the UK as far as everything that made the shake-up in the pound a few weeks ago happen. Now they're trying to reverse gears. Although, if you notice what's happened, this is the irony of it all. So this is when we had the issue with the British pound. So they came out, what was it, right about here, and said, let me make this a little clearer so you can see it. There, and I guess I gotta go to 2. Okay. So they came out and said they were going to have all kinds of tax cuts and blah, 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 and that all of a sudden just slapped the pound down huge. I mean, they were at 113 and they got below 104. A 9-handle break in 2 days. I'm sorry, that is a monumental move. Then you have the recoil back up to this area. Now, I always tell people, markets tend to go out like they come in. You had such an extreme slide, it was most likely that you weren't going to just like consolidate and trend higher. You would have a decent bounce back. Not that it's going to come 100%. The trend is bearish, remember that. So let's see how this did pan out. So if we go from down here and we go to here, this came just above the 0.786 level. It just barely poked through it. Then it rolled over into the next trading session and trended lower. So this was a great swing, lower swing low. Okay, so on a trend basis, that was phenomenal. Obviously, it took out the downward sloping resistance, but that doesn't mean anything. The trend was so exacerbated to the downside, why wouldn't it slingshot back? The key was that it didn't take out this last swing high right here. This is crucial. If it would have done that, this is where the market starts to get neutral, not bullish, but neutral to positive. Okay, below here, below 117.46, this market definitely is bearish. Now, we've had a complete turn of events as far as the news. Remember how we said on this area here that they were going to have all kinds of tax cuts and blah, blah, blah. Now, we have Monday, okay, today. And what happened? They reverse gears. There is new leadership that most likely is going to be taking over and running things, or at least in the short run it looks like that. And they are trying to change what is going on as far as the outlook financially and economically. There's arguments on both sides, who's being responsible fiscally and what have you. Altogether, it doesn't matter. It is a tug of war that has got this currency pair grappling with directions. If there was a sell-off, the market reacted to it the way it did. However, it bounced back and came back right back to where it started from after it absorbed the blow. So that means that it really wasn't looking at it in such a bad way. And one of the things you have to think about is that inflation's been so bad. The tax cuts don't really hurt the government because they're bringing in more than they were before the pandemic because of inflation. Everything is so much more expensive, so they're making more tax revenue. If the government really cared about curbing inflation and helping out the consumer and their constituencies and the citizens of their countries that they represent, and are not their leaders but represent, then they would cut taxes because they're still making more money than they were a couple of years ago in a recessionary environment because of price hikes due to lockdowns and supply chain shortages because of lockdowns, and also inflation caused because of all these shortages, and also the political unrest that is now going on the past year or half a year in the Ukraine and Russia. So that is not what's causing the inflation. However, that is the sanctions on that war are helping to exacerbate all the inflationary trends that are in place, especially in Europe. This is why we're seeing the fact that they thought this news was going to make this market bounce and rally. If the market really thought it was positive, the change that was going on, well, all it did was it took a whack right there because that's how it reacted to the news. Nothing had been done, nothing was going to happen yet, and the impact of that decision, should it actually be an end result, had not had a chance to manifest. So that's why the market gravitated back and came back to here, found a nice pivotal point, because that's right where it was. If you look at where we're at, we are right back where we started. Let's look at right here to right here. See, the market was trading here, bobbling, trending lower, but it was trending lower, and the pound of all the currencies versus the dollar was the strongest until that move. Now we have political uncertainty. That's where now this is going to probably most likely weigh on the pound. So it doesn't matter that they switch gears. They can completely overturn everything that was talked about back here on this date here. It does not matter. It's going to adversely impact the pound because of, one, the lack of certainty and transparency on leadership in the UK. Their economy is collapsing, believe it or not. The tax cuts and everything they wanted to do here would actually help their economy. What they're doing here is going to explode unemployment. Unemployment's going to rise. Inflation is going to continue to rise and be an issue. The government's going to be more strained. The people are going to be more hard-pressed, and that is just the issue. However, I don't think you're going to see the trend totally sell off like it did a couple weeks ago. I think you're going to just continue to trend lower. However, since we got down this low, and now since we have this influx of fighting within the UK government, it is really, I believe that the British pound now has a really good chance at bobbling just above parity or being around parity come the end of the year at the beginning of 2023. Of all the currencies, I thought this would be the one that would hold out the strongest and be hovering at the very least, around where it's at, to where it just set a recent low, and that would be 6 months to 8 months out from now, when I see the euro trading down in the lower 90s, upper 80 handle, the yen still trading very high, and other currencies getting hit versus the dollar. But we'll see how this pans out. Let's see if we have any questions. We don't have any questions on Twitch. Let's see how we got on there. No, nothing there. Okay, but we got another like. Thank you very much. No comments. We would appreciate a comment in this comment section. Chat, whatever, please help us with the algos with that, and make sure you like and subscribe. All right, so British pound, US dollar, we found our areas. Now we know what's going on. So right now, I think that what you have to pay attention to is the fundamentals and the technicals are all looking towards a test of support once again. Only if we take out the recent swing high over here, if we get above here, then I think we'll be bobbling around between 114.94 and 117.46 in this range. You can see this is also where we had a spike high. Unless we can breach 117.46, this market isn't even in neutral. It's definitely a bear. It keeps this market looking to grind maybe as if it will, and I think that's probably what you would see. At least that was originally what I thought we would see. Now with the strife going on within the internal conflict in the government, that changes all of my outlook as far as how that is going to manifest. So now let us take a look at the next currency, US dollar CHF. All right, US dollar CHF sold off in a big way and still looking a little lower, but not really much trading going on in this one. This one, obviously, key off of the recent swing high. This market is a bull. It's making higher move highs and higher move lows. It could be a big sideways. Right now, as the dollar index is under pressure, I would say that use caution. The Swiss has been very volatile. Of many of the currencies, they're not moving. Like the yen really has a range some days, and the Swiss is all over the place. Sometimes the Swiss has a bigger range than the euro and the pound by a long shot lately. I mean, you can see by this volatility, it's been swinging around. And just this patch in the end of September into the beginning of October, you were trading from 97.40 to 99.64, basically in a $2 and 30-cent, 20-cent range almost every day, somehow poking in and around, up and down. So range traders, I think they were getting chewed. Trend traders for sure got eaten up alive. If you didn't just hold on to your position as a stubborn long, I don't know how you didn't get chopped up in that. We had a couple ins and outs. Net, we got out of this breakout with a nice little profit, but still we got definitely lost much of what we had retained from the initial blast all the way up to here once we traded over here. So that's just how it is. That's how the game goes. It's also honesty. Anyone that says you're making money all the time, well, guess what? They're lying to you. Come back to me, and you can go to my website, and we'll do a consulting call, and I'll help square you away with where you went wrong on that one, because I hear all these people saying, oh, you're right 99% of the time. Yeah, that's not possible, even remotely. Just on liquidity and especially during major numbers, how you can get stopped out or limit how you get in or stopped out, and especially if you're trading market orders, you can. There's no way you can tell me that you're making money 99% of the time, let alone 90% of the time. However, it doesn't mean that you cannot be profitable. That's for sure. Just don't gamble. Trading is a business. All right, so back to US dollar Swiss. We are looking for where is this going to go. So we're going to key off the recent swing low and the recent swing high. We're bobbling right at the 0.382. As you can see, 50% is not far away. Neither is the 0.618. We have a nice little area right there for retracement. I think that this is pretty much the extent that you're going to see for a drop in the US dollar Swiss. The main reason is that interest rates, if you look at them, if you go to the Forex-trading-unlock.com website, you go to the futures tab here under markets, and then you scroll down, you go to the US 30-year, click off the ad, or you can punch the ad if it interests you. And we'll clear this up a little bit. We got the 30-year Treasury bond, which, look at this. How many weeks in a row has this thing been tanking? This has been nothing but down, 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 down every single week. Now, it's been a choppy trade. Don't think you just got short and rode this thing down, because it has been a nightmare, especially the last month and a half here. But even today, they tried to lift this bond market, and that was when the dollar was really getting whacked. The bond market was looking like it wanted to, or the interest rate market, 30-year and the 10-year, were looking like they wanted to start to break out to the upside. Instead, now we are treading just above the lows. This is key. We know we have a Fed meeting coming up. Maybe if the interest rates still get a bounce again tomorrow early in the session or even into Wednesday, we might prod down in this 99.13, 98.69 area. I don't really see us getting below here, not just because of the fundamentals. It's just a matter of the strength that the interest rate market has on this currency right now. So let's put this. All right, so if we see how we're trending higher here, and you can see that we're kind of trying to fall out of this, but this is a pretty steep trend line here. To come down in this retracement area, this would be a good stopper, a good breaking point. Also, when you look at, we have these highs right here. Here, here, this was our chop zone, and then we broke out here. This would be a great place to find support. If we fall from here, does it make this market bearish? By no means. It just puts us in a big neutral. However, I don't think that we're going to have the ability to fall below 98.69 today in the next session or two, let alone this week. I think if anything, we're going to bottom out in this area and then reverse gears and make a run back for parity. That's just the way we're set up right now. U.S. dollar JPY, this one, boy, talk about a market that just continues to prod through resistance. The Japanese put a line in the sand. All I can say is this. This market is going higher. We have 150 as a price target. The central bank and the bank Ministry of Finance keep talking. They don't do anything except for buy their bonds, which helps to deflate their currency against the dollar and keep the bulls here for the U.S. dollar yen intact. As far as some of the other news, they may come out and say some blah, 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 blah. However, the Japanese have done something now twice that completely is shocking to me in all my whole career in trading and finance. I've never known them not to do what they say and say what they do. They drew a line in the sand at 130 before the market got to 130 and said that they would start to raise rates or do something to defend their currency because they don't want it to continue to collapse versus the dollar. Well, now we're almost 20 handles higher. So, and when you can see this spike here, this was a bad day for me because I was long going into this high in the 146, and then they come out and say, oh, we're going to defend our currency again. And they got all the way down to a low of 140.34. So that's huge. The high of the day was 145.90, so almost 146. And the low was 140.34. That's over 5.5 handles. That's a big day. Not to mention, this whole thing happened in the course of like just a couple of hours. This is insane. This was with them speaking. And this is not why I don't mean to drag this out, but this is important. Both times they brought speak to the table from their Ministry of Finance and the Bank of Japan. Nothing was done. It was just speak. It did hold the market back. The market reacted, and they never did a thing. They spooked the market all the way down to 140.34. Now it's $8, almost $9 high. It's $8.50 higher than it was the day they said that, oh, we're going to defend our currency. Now we're pushing 150. I think we see a poke through 150. I think we'll bobble around there. Can we see a correction? Absolutely. It's overdue. But I would wait for a sell-off in the dollar to confirm any type of trend reversal. Right now, this market is a buy-dip situation. Be careful with what happens out of Japan. If they actually do something, here's what has to happen. They already said they're locking in their buying rate unlimited to keep their interest rate at 0.25% in the bond market. If that's the case, you can't raise rates and buy the bond market. You're screwing yourself. It's not gonna have any net impact, especially as far as defending your currency and doing what you want it to do. So that's something you need to take into account. So I would watch out for swings, look to buy dips, and especially some big extremes. If this market starts to sell off, pay attention to our videos. We'll be letting you know when we see some radical movement where we think, hey, the dollar's correcting. The U.S. dollar yen should also get a correction as well. All right, now let's go to the AUD USD. All right. Australian dollar, U.S. dollar had a nice rally today, but it's bobbling around the lows. This market is in the gutter. Politically, economically, this country and its currency is totally and unequivocally in the gutter. It's not just the relationship with China and how China just railroads them and runs them over. It's just that what they did with all of the lockdowns, they're paying the price for it. You can't lock down society the way they did, and or anywhere, and not expect unemployment and lives to be completely thrown over in turmoil. You want everyone just to come back. You know, it was one thing when they said, "Oh, it'll only be 2 weeks," and even that was ridiculous. And people said, "Oh, we're just all going on a 2 week vacation." Yeah, sure, the world doesn't stop, let alone for a year and a half, or 2 years, like it has in Australia for many people. They're feeling the ramifications. Businesses are collapsing. Their own production of anything is fluidly just completely diverted in every which way. So if it was supposed to flow one way, now it's not even going anywhere remotely where it needs to. You have all kinds of disruptions in the labor force. People who are not allowed to work because of COVID sanctions or mandates, and these are key people with skills that if they're not allowed to work, you have to train other people. But then those people, there's nobody that either wants to do it or it takes too long to train them before they start to get back into a rhythm with the supply chains and the manufacturing and all. Well, they don't have very much manufacturing, but they do have, well, a little bit when it comes to their manufacturing is more refining of minerals and raw materials and things like that that is sold predominantly to China, but also to the rest of the world. And also with the value of the Australian dollar versus the dollar, it being so crushed and most things being denominated in dollars, any inflation that you see in the pricing of the goods or of the raw materials that they have, key people with skills that if they're not allowed to buy the what do you call it, by the currency conversion. So that's the thing that you have to really kind of pay attention to. We are looking out for any type of change as far as their government is concerned. If they lift the mandates and restrictions, I mean, even just a little bit there, because they are very strict from COVID. I live in Chicagoland, and they just lifted all the mandates for masks in all medical facilities now, which it's amazing how right before the election, all of a sudden, it's like, oh, it's now COVID is just like the flu. So people aren't going on respirators or anything and flooding the hospitals, and all the COVID testing centers are shut down. So because after all, they want to try and salvage whatever they can. So plus the federal money is all running out. Operation Warp Speed ends pretty soon, in a couple of months. So all that free money from the government no longer goes. So people have to start paying for their tests. It's amazing. Once everyone has to pay for their own tests and their vaccinations, all of a sudden it's not such a big deal anymore, is it? So that as a problem in Canada, there it still is. So that means that we are most likely not going to see a retracement beyond this area here where this last swing high was. So we have a 0.618 here. Let's make this red, and this area right here. So this would be our major retracement area, and also put us up against not only the recent swing at that last lower swing high, it puts us above this downward sloping resistance line, keeping the channel intact, let alone, and then puts us up towards the longer term downward channel. So this would be a big area to consolidate, but look at how it would have to, the velocity of a rally up to here would be huge. Odds are it's going to grind and then bounce off of here, and then it won't even get up into this area here. The only thing I could see that would really give this market a chance to get up towards this 65.40, let alone the 66.36 level up here, would be if we see a big sell-off in the dollar. All right, New Zealand dollar, U.S. dollar. Let's see what's going on here. This market is also in the gutter. Let's see, do we have any questions? No, we don't have any questions. You guys are quiet tonight, but that's all right. We got some likes and hopefully some new follows. And anyhow. All right, so New Zealand dollar, U.S. dollar. Let's key off of this last lower swing high at 58.16. This would be our breakout level. All trading below here keeps this market in the gutter, and as far as how low can it go, I think that we're going to get down towards the 53 to 52 cent area. They are also have made so many restrictions that have paralyze their own economy and government. And the reality is, the thing is that Australia and New Zealand, it's not so much the debt load that they have, that it's the capacity with the debt they've now incurred, and the fact that they've locked down their economy so much that they don't have the ability to bring in any cash flow to service any of these decisions that were made. And that means that you're going to see a lot of credit bubble issues coming now, over the next 6 months to 8 months, for sure, globally. And it's going to be not just the underdeveloped countries, the smaller countries, like that stuff that always just gets washed under the rug. But when you have New Zealand, Australia, and other countries like that in complete default, on their treasury securities, well, what is that going to do? So then here's what it is going to do is, it will drive up, ironically, it could drive up the interest rate artificially, in their bond markets, because there won't be any value left. So they could tank. The only thing is, when they tank, that means all of a sudden people are buying it with an expectation of a higher interest rate return. The question is with the default ratio, if that's an issue, it could really just tank. Where, I mean, like, we have, how we've been watching the Fed raise 3/4 of a point pretty much every meeting for the past couple of meetings. Well, think about it. If the Fed was to raise interest rates, say 10-12% just out of nowhere today, what that would do to the marketplace. And it would crash the bond market just from the pricing basis. It would cause a very big short-term rally in the U.S. dollar, and it would cause rampant, an insane amount of ripples into the financial systems and derivatives that would cause all kinds of, I would say, spikes in not just commodity markets, but all the financial markets. They would just completely just go off kilter. And that's the kind of thing that, is it going to happen? The reality is, eventually it will happen. Everything does eventually happen. What will cause it and when will it happen? Well, that's all neither here nor there, and that remains to be seen. But I think that in 6 to 8 months, when these things do collapse, that it will cause an initial rally of these currencies against the U.S. dollar. And when I say an initial rally, we're talking about like that Japanese move, that the move we were talking about in the U.S. dollar yen just a couple of weeks ago, only amplified by 10 times. So you'll see where the New Zealand dollar, for instance, might see a 10-cent rally where you'd go from 56 all the way up to like 65, 70, 80 cents, literally within just a couple of hours. But then, just as it goes up like that, within just a couple hours, you'll see it crash and make new lows that will just stun, as far as the depth of the currency. Because even though the bond market will be artificially high with rates, there'll be nothing to support it as far as their currency, as far as to justify the value. So to justify a high interest rate in that currency and have anyone buy that debt, the currency itself will have to collapse. And then that's the only way anyone would buy the paper. So it's a trap. It's something that most people don't really understand or even take into account. These things only happen every once in a while. Think of it like when the credit default swap situation happened a few years ago, that people capitalized during the Great Recession, if you will. And those derivatives they were able to buy for pennies on the dollar, shorting the market as a whole. Well, this is the same. This is a situation where it won't be just the equity markets. It's going to be a volatility thing. You're going to see every derivative market and every market swing in a way it's never swung before. And the reason I say that is because, unlike any period before in history, we have more volatility and action in the Forex markets, the currency markets, than we've ever had. Not to in a global way. I mean, with the major currencies and the lower and the smaller currencies as well. We've never had this type of volatility, and we've never had this type of interest rate movement either. This is something that is super, super new to the to the derivatives markets. We've never seen this kind of action, this type of volatility on such a big scheme. And that's the thing, is that all these markets are getting jumbled up and gyrating. Guess what? They ain't slowing down, baby. They're gonna get hotter and hotter and hotter. So this is something that I really want you to be aware of. Pay attention to our webinars and watch and see how things manifest, because we're not making this stuff up, folks. Been trading for over 30 years. I've seen some volatility in my life. I've never seen this kind of stuff. And everyone I talk to that has any rationale that comes from the banking and the brokers, the trading aspect, even real estate, that really just gives you the candid stuff, says, yeah, real estate's coming in corporate wise, especially at least a 20 to 30% correction globally. The interest rate market, the corporate bond markets are in for a big hit. We will be in the age of the junk bonds again in the not too distant future. That's where some money will be made. Junk bonds will be big again, but not for at least another 4 to 5 years, but they will be big again. I personally am looking forward to it. It was one of the things that was really big when I was just before I got in the industry, and was really excited about being a part of, and then everything changed. So, but guess what? It's coming full circle. I'm looking forward to that, and that's when you probably won't see me streaming very much. I'll just be paying someone to do that for my company then. Just giving them the outlines, because then I'll be focusing on trading that stuff, because that stuff that's where the big money is, especially once you start to see the interest rates get back up to some decent levels. When mortgages are going off at like 12, 13, 14, 15%, that's when the money is going to be made in the bond market, especially, because it's going to be swinging at levels that everyone, it's unless you're my age or older, you remember it, but all the young kids, they have no clue. They weren't even alive then, and think that it's something that's just an illusion or can't possibly happen. But not only is it going to happen, it's coming sooner than later. So the days of the 0% interest rates and fantasy land, I think, have pretty much are over. So, but hey, keep on hanging on to that thought process. Who knows? Maybe those days will come back again where banks will lend money for nothing. So, all right. So New Zealand dollar, once again, looking to collapse. We're looking for that to get down to at least the 54 to 53.5 cent level. It has to get above 58.65 or 16 rather to change that outlook. U.S. dollar, Canada. All right. So very fun going on with this thing as it tops. Is there a head and shoulder forming here? Maybe. Maybe not. I don't know. We'll see. We'll have to see. This one's a really tough read. It's an untouchable right now. Remember when it was going big sideways? It went like nowhere from here all the way to here. Tried to break out, then finally did. But if you really look at it, it's only, this is it. This is all the market action that's been any fun, and we've had to deal with it. Although it's good from 129 all the way up through 139 up to almost 140. Very, very big move. Instead of being stuck in a $4 or $5 range, it had a $9 range in just over a month. So the question is this a shoulder? Remember how, if you've been paying attention and with us through this whole webinar, if not, go back and watch the beginning. It will be in recording. Okay. Potential head with our top that we had a few sessions back. And now the question is, are we forming another shoulder? Not yet. We're coming off the head. We got to come down and then have something to build on. This slope here, as you can see, we're falling through it. But this is not necessarily negative in the sign that we're going to have a big sell-off yet. This is a good indication that we're going to come back and then find a support base. And if you look at this, so we have the 0.786, .618, and of course our old tried and true 50%. All right, so we're already in the The short-term retracement zone comes just in below our upward sloping support line. Not a bad area. Could this be our new neckline? Maybe. But I wouldn't get too married to this, because if it is, well, we need to build a shoulder. We have a head, we have a shoulder, but we haven't made this. Not, if this is a neckline, we still need to rally first, and then fail to make a new high, and then start to come down. I think what's more likely is that we're still going to come into this area here, bottom here, and then let's put this somewhere over here like that. And this is what I would expect to find. And then set a shoulder somewhere up here. So if you get my drift here. So then kind of like trade down here, trade here, and then go like that. All right. So this is kind of the scenario if it's a head and shoulders. It may not be. Right now we have a very serious bull trend. However, markets tend to go out like they come in. We are starting to get a little toppy, so for us to have a little correction, not outside of the realm of possibility. I could see us easily doing that and coming back at least down to here, down to here, somewhere in this area. So this would be our extended area for selling off. If we get our head and shoulders, then down to here. So actually we would get, it would be down into here. So we'd be looking as far as trading into Nova. And this would go, I would say, the only problem I have with this one is that we would have to get this sell-off, kind of basically come up a little tighter, and then boom, sell off into the Fed meeting. And then I think once we get to the Fed meeting, then we'll find support and then get another big rally. I don't know. I could be totally wrong. So we'll see. So right now, this is a potential head and shoulders forming. It has not formed yet. We don't want to get ahead of ourselves. So anyhow, let's see what we have here on the viewership. Okay, one watching there. Okay, we got a couple there. All right. Okay, well, you guys have been really great today. I want to say thank you very much. And definitely, if you haven't done so, one, check out forex-trading-unlock.com. And you see this little dot here, you can always hit the Twitter thing here, and you tweet it out like that, and that gives us a little share from our website. We would appreciate if you do that. And also, if you go down to products and services here to high probable Japanese candlestick patterns, you can check out the book I wrote. And you can buy it, would be fantastic. You can share it, that will be wonderful as well. And you can also preview it. You can see a little bit about the book, or you can just click on the thing here like this and read the Kindle a little bit and see how that goes. Or you go back to buy, and it brings you to Amazon. And you know what you do? You can click on the buy, and you can either buy it in Kindle or in paperback version. So all different varieties depending on what kind of person you like to read. If you're an Amazon Prime member, by the way, you can read this. And also, when you're on this page, also do the same thing. Hit the Twitter thing and share it for us. It helps with the algos, helps to help us with some sales too, hopefully. And we would really, really appreciate it if you would do that. So, and with that being said, I'm Teddy Keckstedt from Forex-Trading-Unlock.com. I want to thank you very much for your time today, and we will see you soon, all right? And if you have any questions, leave them in the comment section or in the chat box. If it's still live, we'll get to them, and the comment section for sure, and on the video thing, leave a message, and we will answer questions and try and put them into the new webinars, or just answer them directly for you. All right? So you guys have a great night, and we will see you soon. And then we'll also put up, after this, I'm going to put up another stream with some signals for the euro, US dollar. All right? You guys have a good night.